How is everyone? Thank you so much for showing up, you guys. This is the Elevate Equity webinar series. Today, I want to present a very exciting opportunity for everyone and also give you a little bit more of a background about who we are, what we do, and why we're choosing to invest in Indianapolis right now. So I'm excited to get going, and it's great to have you guys with us. So without further ado, let's go ahead and get going. So I'm going to go ahead and share my screen right now so you guys can see what I am looking at. All right. Okay, so you guys should see on the screen right now what the webinar is about. We're talking about Rosedale Hills. It's a 60-unit apartment complex in Indianapolis. And our overall objectives is 17% IRR and 8 to 10% cash and cash return before refinance in years 2 and 3. And then, of course, after that, since all of the capital has been returned, we're looking at an infinite cash on cash return after that for the investors and looking for an 8-year hold. Again, my name is Derek Clifford. I'm one of the general partners who will be involved in this offering. And I have 2 other partners as well. And they will be also available to ask questions and answer questions from you guys. So I'm just looking forward to getting to it with you guys. So tonight's topics, first, where are we at macroeconomically, and why does it make sense to invest right now? I think that's an important question for us to consider, given we're going through COVID right now and potentially facing an election and lots of economic uncertainty. So we should spend some time going over that. And then also, where will we be investing physically? Where is the property located, and why in that physical location? And of course, we'll go over the offering itself, what our business plan is, and then how we're going to mitigate risks as they pop up or as they potentially pop up, executing our business plan and moving forward with the offering. And then at the end, if there's any Q&A, if there's any questions that you guys have, feel free to type them into the comments wherever you're viewing, and then I'll go ahead and take a look at them towards the end of the presentation, and then we can go ahead and cover them and get them answered. So first, let's talk about why right now, okay? Now, where we are is a very unique situation given the course of history over the last 200 years in terms of interest rates and the Fed's attitude towards debt and inflation. Right now, we're sitting in 2020, and as you can see on this great graph that was provided courtesy of Goldman Sachs, and actually this was presented by the Visual Capitalists, so if you don't have them, you should definitely sign up for their articles. They do a fantastic job. And where we are right now is you can see an absolute drop off in interest rates down to 0 levels, at 0. This has never been done before in the Fed's 200-year history, and this is definitely a historic time for us to be able to take advantage of that. In addition to that, the chairman Fed, Jerome Powell, just recently released a statement saying that he would much rather raise interest rates keep interest rates at 0 and let inflation go than raise interest rates, which for investors like us who end up finding ourselves in large amounts of fixed rate debt in apartment buildings, this is fantastic news for us because we can lock up the really, really low interest rates at near 0 levels and really, really get fantastic returns out of our investments. Another thing to consider is why multifamily? Well, when it comes to multifamily, the vacancy rate for rental properties across the United States, you can see that historically the vacancy, and lower is better, by the way, because if you have a 0 vacancy rate, that means you're 100% occupied. Vacancy rate has been declining since the Great Recession back in 2008 and 2009, and we expect this historical rate to at least stick around at that level. No one knows what will happen, but right now at this point, this data is coming from the Fed, the Federal Reserve in St. Louis. And so we give this data a lot of credibility. And it does make sense that people are trying to lock up rental situations right now during the COVID crisis and trying to get themselves settled into a permanent situation where they can be safe for the health crisis that's ongoing right now in the US. And then this chart also kind of underscores that a little bit more. You can see here that the blue line is showing lease rent changes leveling off at about 0. And what's interesting about this chart is that it's actually for the last 6 months or since the beginning of the year. And you can clearly see the dramatic effect that the pandemic had once it started becoming more mainstream in March. And then since then, we've kind of leveled off a little bit. And actually, this was since earlier this summer. So it seems like things have started to return to some level of normalcy. So we're really depending on that trend. We'll be watching it very closely, but this is really promising that apartments are a good place to invest in and to keep tenants happy. And now I want to talk about why Indianapolis specifically. So as you guys may intuitively know, there's been a lot of movement from urban cores out to suburban areas. And we can also see that effect start to really take off in big cities to smaller cities. Many of you guys probably know people, or you yourself may have thought about moving from an expensive area such as the place where I live, which is the Bay Area, move off into a different market. So somewhere like right here is Sacramento or Las Vegas, Salt Lake City, Denver, some of those cheaper markets, because not only is the property more expensive in these urban cores and in these primary markets, but it's cheaper to move out there. And with jobs being more remote these days, people are trying to look for more affordable situations to live in. So we think that Indiana is one of those, or Indianapolis specifically, is one of those markets where people are going to be moving to because of the low cost of living and the high quality of life for every dollar that you spend in the real estate there. So we're very excited about that trend, and we're going to be continuing to watch that one. And then going further into the city of Indianapolis, the occupancy rate as of the second quarter of 2020, this is from data from Berkadia, has been pretty much level since 1 year ago. Since the last quarter in 2019, when the economy was ripping and roaring out there and across the US, we've only seen the occupancy go down by 0.1%. That's the 10 BPS that we see there. So occupancy has been pretty strong. The effective rents have still been up since 2019, the middle of 2019. And then, of course, the rent payments have been about 88.5% collected, and that's up 0.3% since June. So these are all really good things to see about Indianapolis itself. So there's just a lot of good things that we see there, and we continue to invest. Another thing that's important to know is, all right, well, how many jobs have been lost? Obviously, there has been jobs lost because of the pandemic, but because of Indianapolis's very diverse nature of job markets, the Indianapolis in the Midwestern region has not really suffered as much as other Midwestern cities have, and people are still enjoying being employed because of the diversification of employers in the market. So I really attribute the success of the city planners and the leadership in Indianapolis really focusing on tax incentive to attract the right businesses into the city. And that's always been the case ever since I've invested in Indianapolis. And I want to continue to believe that trend is still holding true. And so far it has been in spades, even through March and April. And here's a little bit more data about supply and forecast in Indianapolis. Again, really just underscoring the strength of Indianapolis as well. There are some categories like year-over-year job growth that seem to be taking a little bit of a blip in comparison to some of the other bigger cities. But I think in general, Indianapolis is in one of those healthy places where year-over-year rent growth is high, occupancy is relatively stable, and that's really what we're looking for, is stability. Okay, now that we've got why Indy down and why we believe in this market, I want to go a little bit more into the actual offering itself. Rosedale Hills is 60 units, and it's located in this map here, right there where the pin is. And there are a lot of different circles around the individual apartment complex itself. There's Beach Grove to the east, and then downtown and Fountain Square, which have both been on fire for the last 3, 4, 5, actually 10 years, and been really taken off, are expanding. And then, of course, Southport and Greenwood is a very wealthy, affluent area where lots of people who work in the city end up driving and commuting into. So what we like about this property is it's uniquely positioned next to a university, literally less than a quarter of a mile away, and all of these areas that are kind of surrounding the property itself. So in talking extensively with some of my contacts and other investors and property managers about this building, it's very clear that the path of progress is moving in that direction. And eventually the appreciation is going to be pretty nice in this area because these pockets are just surrounding it and expanding. And just to go over a little bit more, the purchase price that we're getting this under contract for is $3.3 million. It's actually 3.15 because of some credits that we're getting from the seller. And then we've got 3.2 acres of raw land right behind the property itself. So it's hard to tell in this picture, but it's actually right back here in the green area behind this building. There's been one owner that has maintained the property meticulously since the 80s. And so that's something that we like to see. And when we were doing our initial due diligence, we kind of noticed that, the gutters were brand new. The roofs looked like they'd been recently replaced. The windows looked to be in really good shape. And everything seemed to be clean, tidy, and in order, which means that there's really a nice sense of pride of ownership there. And when things need to be addressed, it seems like the owner has gone in and taken care of things pretty well. Actually, I think a couple months ago, the landlord had replaced a parking lot as well. So to be able to enjoy some of those recently renovated things and maintained property. And there's ample parking as well. There's 1.5 spaces for every unit. And with the unit mix that we have in there, mostly one bedrooms, there should be plenty of parking for others. And we also have a covered parking spot also that's to the left of this photo that we might be able to go in and actually charge a little bit extra for as well for income. And then, of course, it has to be said that there's easy access to downtown as well. It's very, very easy to get into from Rosedale Hills into downtown. It's literally 30 seconds up the road on a road called Keystone. You just got to go out Rosedale Hills, make a left, and then you hit I-65 and you can run straight up to Indianapolis within 5 minutes of the property. Now, let's talk about why this makes sense as an investment. For the investor, we're looking at 8 to 10% cash on cash return in years 1 to 3, and then we're looking to refinance in year 2 or 3. And what's unique about this particular investment and what Elevate Equity does with their investments is we like to prioritize the return of investor capital. So what we want to do is we want to make sure that we're taking care of all of our investor partners, and we provide all of the cash flow goes straight to the investors, where most other investment arrangements, you have a split between the managers and then the investors, and the managers take a portion of that cash flow at the beginning. But our number one priority is returning back all of the investor capital that was put into the property in a refinance in year 2 or 3, so that way the investor can go and continue to hold their equity stake in the property while they have all of their cash back out in years 2 or 3. And all the while doing that, we want to make sure that we're targeting a 17% internal rate of return, which means averaged out over the 8-year hold, we want to make sure that we're looking at a 17% return on investment, with considering the time value of money as it erodes over time as well. So now that we've talked about what the business plan is, let's go ahead and jump into what the property looks like itself and go in a little bit deeper to that. So what I'm going to do is I'm going to exit full screen mode. I'm going to go to this. And actually, let me also put myself on so you can see me as well. Okay. So we've got Rosedale Hills here. This is the flyer. And so anyone who's interested, I'd be more than happy to send this out to you. Here's an aerial snapshot of the property. You can see the 3.2 acres behind the property that we could sell off or we can utilize otherwise as an amenity for the tenants inside. What I really wanted to underscore here was how the business plan works. The equity split is 65-35. So the investors bring in the cash and they earn 65% of the equity, but the cash flow up until we refinance is all going to the investors. So when we have income coming in of $188,000 per year, and then $200 for year 2, and then $229 for year 3, all of that cash flow belongs to the investors, which equates to about $9,700 for every $100,000 invested into the property. That's a great 9.72%, 11%. And then, of course, once we do the refinance and pay back all of the original capital, so if you take the sum of $9,700 plus $1,100 plus $79, that gives back the $100K. The cash on cash return is infinite, basically, because you have no more original cash invested in the deal, but you still carry the 65% equity all the way through when we resell in year number 8. And then we expect to be able to return $93,000 for every $100,000 invested then, as well as a nice little cash flow for you until we end up selling the property. So the cumulative return total is $213,000. So taking away the $100,000 basis, that's 113 grand, or pretty much doubling your money and a little bit more over the 7-8 years that we plan on being in the investment. And then here is a real quick snapshot of what we're planning on doing in year number 1. First thing we're going to do is onboard the property manager and then rebrand the building and build a web presence to get the building out there so more people can be involved. And then we're going to get some exterior upgrades. We're going to do some paint and lighting, and then we're going to work on the courtyard in the middle, and then start doing some interior common area upgrades like paint, flooring as needed. And then, of course, as tenants leave or we have some turnover, not only are we going to implement RUBS, which for those of you that don't know, means that we're going to be billing back for a water and sewer bill, because everything in Indianapolis usually goes to one master meter. So we're going to start to bill each unit about $20 to help us compensate for the water and the sewer bill that we have to foot as the landlords and as the investors. So as those leases expire, we're going to gently increase the rents as we see fit, and then implement RUBS or start charging water bill backs as we turn the units around as well. And just to give you guys a quick snapshot of where we are, there's 38 one-bedrooms, 18 two-bedrooms, and 4 three-bedrooms. And the square footage is very ample for the area, and the rents are extremely low. So even with the condition that the units are in right now, we think that we can charge about $50 more for every one of the units, which means that we'd be able to boost our monthly income up by quite a bit. And then over the course of the year, that adds up to be quite a lot. So this is a pretty nice figure for us to be able to just walk in and have the right to be able to charge that. Whether or not we actually do it, we'll get into that a little bit later on, given all the COVID risks and what we have going on at the property as well. So that's pretty much a quick overview of the property. Here's some photos from the inside where you can see the condition of the units. It's a very standard Midwestern property. And these are the floor plans. And then, of course, this right here is how we're going to be using the funds. So with the purchase price being 3.3, we're going to be needing $1.06 million in capital from investors, where 825 of that will be needed for the down payment, and then 123 will be needed for closing costs, and then 111 will be needed for cash reserves. And then don't forget as well that we're getting the $150,000 credit from the seller that we've pre-negotiated before getting under contract. So that adds up to a total of about $1.06 million. And then here's the pro forma. One thing I do want to point out here as well, you can see a very modest increase in rents over the years. We don't want to be too aggressive with it, but this is what we expect we expect the trend to hold. And then one other thing too is that if you look at all of the expenses we have here, we're looking at about $223,000 in total expenses, and the total income that we expect to receive in the first year is about $410,000. So of the income coming in, we're actually expecting to spend more than we end up netting, which is a very conservative underwriting tactic that we're putting in here. Okay. So that being said, let's go back and look at this. So just to summarize again, we're looking at 8 to 10% cash on cash return for years 1 to 3, refinancing in year 2 and 3, and then prioritizing the return of all investor capital, and then trying to hit that 17% annualized IRR target as well. All right. So with that being said, let me go into full screen again, and we're going to continue. So let's talk about risks. Obviously, that's one of the main things that everyone thinks about when they're writing a very large check and getting ready to invest in an investment that's not as modest as going out and buying a new computer or buying a new car. This is something that we really have to consider. And one of the main things with COVID coming and with economic potential for economic fluctuations and uncertainty, conservative underwriting is one of the most important things we can do, because without the underwriting, we wouldn't even be talking about the property itself. With conservative underwriting, we underpay for a property and make sure that when we go in to operate it, that the expenses are realistic and that the income is realistic, even considering worst case scenarios. So we've already done that with our underwriting, And as I said before, our expense ratio is 54%, which means we are assuming higher expenses in our due diligence. But again, they should be a little bit lower. That's the way that we've underwritten it to make sure that it performs to the investor satisfaction. And then as we talked about, raw land is included with the sale in the back. So if we need to, we can sell the raw land, and that raw land has been valued at somewhere around $150,000 to $200,000. So if we need to, we can take care of that, but we would like to hold on to the land to either use it as an amenity for the tenants that are there, or of course we can go ahead and just sell it later on when the value appreciates along with the property itself. And then the other thing we can do is we can implement a rent by the bedroom strategy if we need to for college students. Now, generally, it's a little bit riskier to do that on the income side, but it is an extra strategy that we can implement if we want to start to bring some of the income up during a certain part of the year. Maybe we can do 6-month leases or 8-month leases during the school year once all the schools return back to in-person classroom. So that's something that we can do, because usually it's an easy way to bump up the extra income in some of the larger units, in the 2 and 3 bedroom units. The other thing is that the city of Indianapolis is fantastic with rental assistance. So if a tenant is experiencing some sort of hardship that's due to COVID, then the city will go ahead and compensate the landlord about 3 months of rent all up front for that. Of course, there are strings that come with that, and it also includes conditions that you have to have loans in place that are conforming with the federal government, with Fannie Mae and Freddie Mac. But all of that stuff we make sure to keep into consideration when we're doing our underwriting and putting the property under contract. So that will be available to us as needed. And then, of course, the lender is also going to require that we raise a little bit of extra money and keep that as an escrowed account. In this case, it's usually about 9 months to a year of interest payments. Or interest and principal payments. So in this particular case, it'll be about $125,000 to $150,000, depending on all the exact numbers once we get into closing. So that'll be an extra cash pad that we'll have available in months 9 through 12 once we close on the property, as long as we're making payments on the mortgage, which obviously we're prepared to do. And then another thing about the management team, there's 3 of us. We have a deep local Rolodex for problem solving and figuring out what needs to be done at the property for the right price. And all of us have over 100 units combined in the market and many multifamily investments already owned. We're also very well connected. I personally have access to some very seasoned apartment investors that own thousands and thousands of doors across the United States. And all I have to do is pick up the phone and ask them if we run into an issue that we don't know or we have a problem with. They would be able to certainly help and provide resources for us. And then, of course, the business plan calls for no increases in the first part of the year once we close, just because of all of the uncertainty with COVID. And so we just want to make sure that we're just operating the building as is and just moving forward with the plan, so that once we get out of this situation and this uncertainty, we can adjust as needed and start to raise the rents once we get a little bit more certainty as to who we should be targeting and what type of rents the tenants and the residents will be able to provide. Okay. That being said, that's all I have on the property itself. If you are interested, please visit our website at elevateequity.org and then click on the link in the banner that says partner with us and fill out that form. That link, I'll go ahead and put it in the comments after the stream is over. I'll put it in YouTube and in Facebook for those of you that are watching there. And then we'll get that going. I will then be in touch with you very shortly to talk about your experience, your investing, why you're looking at investing, and what your personal situation is, and just to make sure that we're a good fit. And then commitments will need to be on a first come, first serve basis. And we will be closing off commitments on 10/7. So if you don't put in the form, if you wait until after 10/7, most likely we'll be closing the offering up to investors at that point. So please go ahead and do that before next Friday. And if you haven't received a copy of the flyer, just go ahead and fill out the form. I'll go ahead and send it to you and make sure that you have a copy of that. All right. And so with that, I just want to thank you guys so much for your time. And I hope that it was informative and helpful. And I'm going to go ahead and open it up for some Q&A. So let me go ahead and get into StreamYard again and see if there are any questions. All right. Okay. So I don't see any questions, which is good. With that, you guys, if there is no questions, I'm going to give it just another minute for you guys to type questions in or ask. So I'm getting one. Go ahead and type your questions in. All right. So I see one question. One question that I have that came up was, how do taxes work on the refinance returns? Well, that's great news. So whenever we do refinances, they are not. It's just like if you had your personal residence. When a refinance comes out, there is no tax liability. So if you had your own private residence and you had built up a bunch of equity in your house, there's no repercussions there. So tax-wise, you should be 100% okay. Hopefully that answers your question. Okay, and then another one is, so after investor funds returned after 2-3 years, the investor's share of equity stays in the sale. That's absolutely true. Yep. 100%. So again, what we're trying to do here is we're trying to build up the equity and return it right back as soon as possible in 2 to 3 years. So all the managers, including ourselves, we're trying to run the property as fellow investors and what we would want, what we would want personally. Obviously, our split is a little bit aggressive. It's a little bit higher than most others, but we understand that in this type of environment right now, in COVID, with all the economic uncertainty, we believe in multifamily investing because of the low interest rates and because of the safety of numbers and the number of units inside the property. But at the same time, you may want to invest in something else, right? Who knows what will happen in the next 2 to 3 years? So what we want to do is return that capital back to you so you have use of it again to move forward. So yes, to answer your question, yeah. And so I get also the question, does cash flow end at refi or continue? Yeah, do GPs have funds invested? Yeah, great question. So the cash flow will continue until sale, but the cash flow is 100% until we refinance and return all of your capital back to you. And then from that point forward, it's a split of 65-35. Where you get 65% of the cash flow after the debt is the new debt's in place, and then the managers end up getting 35%. And then your second question was, do GPs have funds invested? Absolutely, we do. We want to make sure that we're showing to you guys that we're just as committed to this as we are. So, the investors, the fellow GPs and I, we're planning on putting in about 50,000 of our own cash into this each. Just to make sure that you guys know that we're in this boat together. Okay. And then someone is also asking, can you briefly explain how you add $800K value in 3 years to be able to refinance? Yes, absolutely. So this is one of the powerful things about commercial real estate. Okay. In commercial real estate, the value of a building is established by the net operating income that you create in the building. So let's say that you have rents of $1,000 per month, which is not the case in this property, but just for ease of example, it's $1,000. And your expenses are $500, right, per month. So your net operating income is that remaining $500 piece. If you multiply that out over all of the units, that's a lot. That's a lot of income. And so what happens if you raise rents to $1,100, right? And then you decrease expenses to $400. Now your net operating income is $700 per door. And that multiplied out over all the units and then also divided by what's called a cap rate, which is about 6% in this case. You take that income, you divide it by 0.06, and that's where that $800,000 in refi comes from. Hopefully that answers your question. And if not, then we can go ahead and talk about that a little bit more as well. If you just want to set up a time to talk with me, because it does involve a little bit of math and I don't know how much people are going to math here on this webinar. Okay, and then one more comment here. Equity increased payout to investors happens at sale and initial investment returned after refi. That's correct. So again, what we're going to do is, let's say, for ease of argument, $100,000 is invested into the property. We're going to keep track of how much we've paid out every month or every quarter to the investors. And once we hit all of the return of that $1.06 million that we're trying to bring to the table in order to close on this, once we hit that amount plus the refinance in year 2 at $800,000, that means that we should have paid off all the investors. And us as the general partners, we're going to be extremely motivated to try to get that as quickly as possible so that we, all of us, you guys can get your cash back, and we as the general partners can start to receive our equity split of 35%. The sooner the better, because then if we end up doing that quicker, right, then we may be able to sell the property in year 6 or year 7, which will jack up the returns a lot. And I'm sure that on that back end, it would be very nice for you guys to have that additional $80,000 as well. So, okay, and then I see another question: is 6% cap rate a good deal for Indy market? Yes, I would say that it is right now, given the competition right now. When I purchased my multifamily property, the one that I have right now, we bought it for very cheap, but there was no income coming in. And we just did a refinance, and it's stable, and it's the same type of property, and the cap rate is 5.25 right now is what we're getting out of that property. So picking up a property at a 6 cap is great. You want to make sure that you obtain a property at a high cap rate, and then over time you operate it and try to compress it down, because when you divide by a smaller number, the value goes up quite a lot. So if we end up buying a property, $3.3 million property like this one at a 6 cap, and then we can compress it down to a 5 cap with the operating income being the same, then the value is going to go up quite a lot, almost to like $4 or $5 million if we kept the net operating income the same. And then that spread between the 3.3 and the $4 or $5 million, whatever we make on it, that spread gets split 65-35 on the sale. So hopefully that helps. May have been a little bit long-winded for that question, but hopefully that gets the gist of what you were looking for. And then another question, really, really good questions here. Thank you guys so much. Will investors get a K1 for depreciation deduction? And is the depreciation on a shorter term, like 5 to 7 years versus 30? Yes, absolutely. So we're going to be providing a K1 for you to be able to take to your accountant, or if you do taxes yourself, you'll be able to take the information. And depending on whatever your ownership entity is, you can buy an equity stake in this property with an LLC or with your IRA, which is something that I should also go into a little bit more as well. Or you can just buy it cash. You can get into the property, and then whatever the title is held in, you're going to get a K1 addressed to that entity. And the K1 will have depreciation, all the expenses and all that good stuff, as if you were owning the property and operating it yourself, but obviously you're not. That's what comes with the equity. And then, of course, for depreciation, we're going to be doing a cost segregation study the minute we close. And what that means is for most people who own a single family home, you take your house and then you straight line depreciate it over 27 and a half years. That's what the IRS says you can do. But with apartment buildings, because of the sheer scale and size, we can afford to hire a cost segregation engineer to come in and tally up all of the beams, all of the bricks, all of the drywall, all of the refrigerators, all of the stuff that makes up the apartment building, and convert it from a real property to personal property. And when you convert it to personal property, you can compress the depreciation period from 30 years or 27 and a half years into a 12, 7, or 5-year period, depending on what type of material is there in the building. So, beams and wood and appliances, they have different, depreciation schedules. But the general gist is that we're compressing the depreciation. So the net result is that you're going to actually end up with positive cash flow in hand. But when it comes to the IRS, you're going to be showing a loss, which is beautiful. I love it. So really good question. Hopefully that helped cover that one. And then is the investor's share of equity at sale the percentage of funds into the deal? Yes and no. So when people contribute money into the investment, let's say that of the 1.06 or 1.1 that we're looking to raise for this property, you go ahead and put in $100,000. You'd think that was actually going to be 100,000 or 10% of the equity in the property, but there's also the GP split. So because the general partners are taking 35% of the equity, right? The 1.06 million that's going into the property is actually making up 65% of the equity. So it's not exactly 1-to-1, but I am continuing to say though that the cash flow in the first couple of years, it will be 1-to-1. So the cash flow will be, but not the equity. So hopefully that makes sense. And the reason we're doing that is we want to incentivize us as the operators to make sure that we're really paying attention to the property. Because if we didn't have any equity for the time that we've been putting in, then we wouldn't be motivated to really, really push the numbers for you. Because there's not only is there the layer of performing for the investors, but there's also the layer of performing well for ourselves and getting return for ourselves. So hopefully that makes good sense to you guys. Okay. And then any idea of how much the depreciation number would be annually? That is a great question. And I wish that I could give you an answer right now. But in drawing from experience from my previous syndications where I was a limited partner, it more than covers the income that comes in. I would say, from the stake that we put in, and when we were getting some returns from it, right now they've paused distributions, but when we were getting distributions, I think we were getting somewhere around like $20,000 per year for our stake. And then our tax liability ended up coming out to be like -35 or, -30 in that range. So it more than covers it. I wouldn't say double, but definitely enough to make a net negative. So good question there. Thank you so much. All right. Anything else that I can answer for you guys? Really, really good questions. And thank you guys so much for being here. I really appreciate it. Oh, and then another question is, could we invest through a self-directed IRA? Absolutely, you can, as long as it's something that you have already set up. Because obviously we're looking for commitments here in the near term and pretty quickly. If you don't have a self-directed IRA set up, then it probably will take a little bit of time to get that set up, but don't worry, there's other opportunities in the future. If you want to take advantage of this particular one, doing a self IRA is one of the is a really good way to do it. But I do want to talk one-on-one because there are some things about self-directed IRAs that you have to be aware of. It's called the UBIT tax, and I want to make sure that that investors are educated on that as well. So I'll go ahead and follow up with that individual who asked the question about a self-directed IRA. But we do highly recommend using that because it's a great way to break into apartment investing and start to build rapport with an operator, and also get your feet wet and understand how it all works. So hopefully that's an option for you. So I do encourage people to look into self-directed IRAs as well. All right. Anything else we can cover here? All right. And then the other question that I got is this your first apartment deal as a GP? Yes, it is my first apartment deal as a GP, but the good news is that I already own multifamily, and so do other people on my team. And I've also got very experienced people who own thousands and thousands of units behind me, and I talk to them every single week. So I have the support network of them, and I'm very confident that I have exactly what I need in order to take this down. So if you have any questions, though, I'm here to answer them, and just hit me up, and we'll make sure your questions get answered. No problem. No problem. You're welcome. Okay. All right. Well, if that's everything, guys, then I'm going to go ahead and end the broadcast, and then I'll put some links up as well for you guys to easily fill out the paperwork if you're interested, and give me a feel for where you're at and how much you're interested in contributing. And like I said, we will be finished accepting funds by next Friday. So if you have any questions, there's also a link on my website to book some time to talk with me in case you don't want to sign up. but I will be here to support you. And I just want everyone to learn, grow, and do really well together so we can all escape our 9 to 5. All right? Okay. Thank you, everyone. Really appreciate it. And please reach out. Have a great night, okay?